It's finally time to start practicing the steps of the accounting cycle, at least those that occur during the period. And I'll be honest with you, nearly everything that we cover in this module, it ought to be a review of what you learned from prior courses. So accordingly, I would invite you to try your best to complete all parts of this application exercise on your own, and only watch the rest of these video walkthroughs to the extent that you need additional explanation. Knowing how to construct basic journal entries, being able to work your way through T accounts, these are foundational skills that we will use extensively throughout the rest of the semester. So it's important that you've got them nailed down. As one final note, I know I provide multiple formats, but this week I really would encourage everyone to use the Excel workbook that I've put together. I've included formulas that should help speed up your work towards the end of the assignment. So let's go take a look at what's contained there. So here you've got 13 transactions for which you'll be preparing journal entries on this right-hand side. And as you can see, the first one's been done for you. A debit to cash and a credit to common stock for $35,000. Now typically, I would also indent the account title that's being credited. We're just doing our best here in this Excel environment. So if you will, please work through the remaining 12 transactions and prepare those associated journal entries to the best of your ability. Each of these lines has been set up as a drop-down, where if you click the down arrow, you can select the account titles, and I'd encourage you to complete it this way. If you try typing it out, you will have to exactly match the account titles that are listed here, otherwise Excel is going to shout at you. I expect that many of you will find a lot of this straightforward, with maybe one or two that you struggle with, and that's okay. But just pause the video now, give it your best shot on your own, and then I'll provide some solutions. And now, as I walk through the answers to these, I want to share a quick thought that might be helpful to some of you. If for any of these transactions today, or honestly, for any problem that we do down the road, if you still have trouble understanding it, even after my explanation, I encourage you to write that down. Keep it handy so when we're in class, I might ask, does anyone have questions about the material? You'll have that reference ready and I can help give you additional clarity at that point. So let's walk through these now. For the first 3 transactions, I'm not just going to provide the journal entry, I also want to illustrate how the transaction impacts the accounting equation. So with number 1, we're receiving cash from investors. They've come to us to provide capital, and we're happy to give them part ownership of the company. So we get $35,000 cash. As an asset account, it gets the debit. And then the credit account is going to be an equity common stock account. Equity increases with credits. So in this transaction, the accounting equation reflects both an increase to assets as well as an increase to our equity. Number 2, we're getting another influx of cash, $20,000 from the bank, so that's an easy debit. But this form of financing is inherently different than what we did in the previous question. With a 2-year note or a loan, a note is a fancy term for the contractual formal agreement, we now have an obligation to pay back that capital in the future, probably with some interest, right? But in this case, we have not given up ownership of the company. So this time we are going to credit notes payable for that same amount. In this case, our assets and our liabilities have been impacted by this transaction. Number 3, this time we're paying cash, $24,000, in exchange for the ability to use a warehouse space for rent for 1 year. So as a cash outflow, it's now going to be credited for $24,000. But what are we going to debit? Is this cost an expense? Are we paying off a liability account? Not in this case. This right of use of that warehouse, that's technically an asset. Prepaid expenses reflect asset accounts. So we debit prepaid rent for the $24,000. And this is where it's interesting going back to the accounting equation. This transaction reflects both an increase and a decrease in our asset at the same time, but still a dual and equal impact on that equation. It's a real handy tool, you guys. Okay, that's the last time we'll relate it back to the accounting equation. Let's just try to zip through the rest of these solutions. Number 4, purchasing equipment for $9,000 cash. Equipment's an asset, it gets the debit. We credit out that cash because we're paying it out. Number 5, we're making a purchase, but this time we're purchasing inventory and we're doing so on account. So we will debit our inventory for $30,000, but because we have not yet paid the cash for this purchase, we credit a liability account, accounts payable. Number 6, purchasing $2,000 of supplies for cash. That's the same song and dance with number 4. Debit an asset, credit cash. Number 7, this is one where I noticed on the first day of class, students tend to struggle. We're selling inventory that cost $8,000 for $12,000 cash. And students have trouble. How do I reconcile? We're receiving $12,000, but the inventory cost $8,000. How do we reconcile that $4,000 difference? Let me just show you. It's in 2 parts. First, we're going to keep track of the sale. $12,000 of cash is coming into the business. And that full amount of consideration that we're receiving, that is our sales revenue. That revenue is an equity account that's going to be credited and increased. But then we have to keep track of that inventory. And it's natural enough to remember, okay, we're going to credit an asset as it leaves our company. We do it at its original cost of $8,000. And this is the one students tend to forget. The expense of losing that asset to generate this sale, we call that cost of goods sold. So do try to remember, we're breaking this journal entry into 2 parts. Recognize the sale and write the inventory off your books. Number 8, pretty similar setup, right? But this time we just sold additional inventory on account. The numbers obviously change, but in terms of account titles, we now debit accounts receivable at the start instead of cash. We're going to get that later on. Number 9, we are now making payment of $15,000 to a vendor to settle half of our accounts payable we had before. So when we decrease our accounts payable, we do that with a debit, and we do that by crediting cash for $15,000. Okay, number 10, another interesting one that you gotta rack your brain to remember how we account for these. We now receive a $3,000 prepayment for a customer sales order, but we haven't yet shipped the goods. In other words, we haven't really earned our share of that revenue. We've got the cash, so we can debit that, but we're going to credit a deferred revenue account. It's a liability. We have not yet earned it. We still have an obligation to a customer, so we keep that in deferred revenue until we fulfill our part of the bargain. Number 11, payment of salaries to employees. We can easily debit a salaries expense, crediting cash. Number 12, we're now receiving a payment from a customer, so we're getting cash, decrease in accounts receivable with a credit. And then number 13, we're paying our own shareholders a cash dividend of $1,000. Dividends are an interesting one. Dividends do not show up on the income statement. They are a temporary account. We'll focus on them later in class. But when we pay this dividend, we can go ahead and recognize recording that dividend of $1,000 and credit cash. Sometimes there might be timing differences from the day that you declare dividends versus pay them. With this information, that's a pretty straightforward journal entry of debit dividends, credit cash. All right, so like I said, this is the bread and butter of an accounting education. Not because journal entries themselves are important. Information systems are largely processing these on their own, but they are an effective way of teaching you how transactions end up in the financial statements. And we'll be using these skills the rest of the semester.